My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make a little money. My job is not just to entertain, but to teach you how this works. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We have got two markets, the sane and the silly.
House of pleasure.
The sane's in industrial America. The silly, Silicon Valley. Every day we see this radical divergence between rational old line companies and the new line sleight of hand that characterizes so much tech. It plays out against a backdrop of what Fed Chief Jay Powell wants because, well, the Fed's still the most important determinant of the action right now. Jay Powell gave an interview where he seemed congenial, laid back even, talked about the guitar and, of course, potential rate hikes. So the averages roared. Then he acknowledged that interest rates would need to stay high for longer, with no rate cuts in sight. Then the averages plummeted. But then they bounced back from the lows. Perhaps because Powell really didn't say anything new at all. And ultimately, the Dow finished up 260 points, S&P gained 1.29%, and the Nasdaq pole vaulted 1.90%. Unlike the myriad bears who rule Wall Street, I think the temporary sell-off was nuts. It's insane that so many people seem to believe the Fed will go from slamming the brakes on the economy to hitting the gas within a matter of months. Yet that's the majority view, at least as reflected by the bond market, which is predicting a recession and a series of rate cuts. Maybe as soon as later this year. I am calling it the bond market, not the bond market, because it seems to be powered more by cannabis, not dollars. I'm sticking with my view that we are in a bull market now, so when the averages get slammed, as they did after Powell said something extremely obvious, as I told club members in our new home stretch program, it is a, yes, indeed, buying opportunity. Sure enough, we bounced back in part because more and more people believe in the bull. But let's get to the insane dichotomy between tech and the industrials that plays out every day. For over a year now, what have I told you? I have said you need to buy the stocks of companies that make things and do stuff at a profit, provided they return those profits to shareholders via dividends or buybacks, and have reasonably priced stocks. That's what I've said. It's been right. I'm sticking with it. And that's exactly what DuPont, the old diversified specialty chemical company, gave you today. DuPont made a lot of money on an operating basis, rolled out a $3.25 billion accelerated buyback program, retired $2.5 billion of long-term debt, all while generating 8% organic revenue growth. What could you ask for more? Oh, I'll tell you what. How about a 9% dividend boost for good measure? And that's why that stock jumped 7%.
That was easy.
DuPont's led by Ed Breen. He's a seasoned CEO. You know what he is? A grown-up who knows what shareholders really want. He understands how to run a company. He's got a long track record of selling off slow-growth divisions, using the proceeds to reward shareholders and buy higher-growth entities. Yet DuPont still trades at around 20 times earnings. That's what makes it a true bargain. But that's the industrial economy. Now let's switch. Let's say foci, because what I'm going to leave are the companies that make a lot of money, throw it at shareholders, and give you a reason price shock, and go into Alice in Wonderland. That's the tech world. A couple of ways tech stocks go higher. First, by learning how to lay off huge chunks of your workforce. Take Zoom Video, once the belle of the COVID bull, run by a truly good guy, Eric Yuan. His stock has been going absolutely nowhere. Well, it did fall from 588 and change to the peak down to the 70s. Today, Yuan announced that he's laying off 15% of the workforce in a blog post, no less. And Zoom stock, what did it do? Well, true to the way tech trades, it went up 10%. That's tech valuation creation to a T. And Eric Yuan, I don't mean to offend you, but that's what happened, okay? Now I want you to consider the industrial stock of Linde. It's a gas company, industrial gas. You can't see it. It's a phenomenal industrial. This morning, they reported an excellent quarter, 20% earnings growth, not the measly growth we were getting from so many tech companies, or the profitless high-growth stocks that I despise. Linde boosts its dividend every year, and it's doing a monster buyback, although it's paused for the moment. But I think it's going to start up again very soon, and the stock will go up even more. You want to get in ahead of it. The CEO, Sanjeev Lamba, told an amazing story about all sorts of gases that are integral to the new economy. You need them to make high-end semiconductors, operate hydrogen fuel cells, create blue ammonia, which is needed for fertilizers. Land-use growth is consistent. It's been doubted and doubted, including this morning when the stock looked like it was going to open down 4. But then when management explained how the quarter unfolded in the conference call, the stock pirouetted and proceeded to finish the day up 14. What a reversal. More on this one later. In the tech world, oh no. All you got to do is say, we're doing AI, something artificial intelligence, your stock flies. Now, admittedly, it is a big deal when Microsoft's rolling it out. They're a real company. They have grown-ups. They are using AI to gin up a better search engine, something more powerful than the also-ran Bing. You want to take a vacation in Mexico? You talk to it. It gives, the souped-up Bing will book you a 5-day trip. Give you an itinerary. Not bad. Sounds cool. Bing is still an unpopular search engine, though. Google's way ahead, and Microsoft's such a gigantic company, I don't know if it would actually move the needle. I know it's a serious initiative, though, but I don't know if it's enough to justify the stock's 4.2% run today. Although I'm pretty happy because the trust owns it. We got crushed when we learned that their cloud business, Azure, was slowing. Now the stock's much higher than it was before the quarterly conference call. You have to hold on to the good ones. Google's got Bard. I mean, it's like Shakespeare, huh? A competitor to ChatGPT, the AI platform from OpenAI, which Microsoft's investing. Now, Bard's trying to figure out how they can get your cell phone to answer questions without ruining their local ads that won't be blocked, because they're not going to be looked at, because you don't need to look at anything when you're giving it voice commands. No matter what, though, Google can't allow itself to fall behind Microsoft or lose its lead in search. Search is so lucrative. So you end up with an AI arms race. That's the legitimate side of the story. Right now, the market's rewarding anything with AI connection, at least for a couple of days, no matter how tenuous. We got companies like C3 AI, which trades in the symbol AI, and the stock's been roaring purely because people are talking about AI. Today, the stock plunged 11% because C3 AI is an actual business, not just a concept, and business isn't really good. These guys have sales, but in terms of earnings, losing fortunes doesn't fit my profile. Let's remember, there are lots of pretenders out there. There's SoundHound AI, which has suddenly become a real AI blue chip, making sure it's part of the ChatGPT conversation. Everyone wanted in on this one until the stock tumbled 10%. My view, if you want to play AI, let's not fool around. Let's buy the real AI company. That's NVIDIA. Because all these artificial intelligence technologies you hear about are powered by their chips. Unlike the pretenders, NVIDIA actually makes money. How refreshing! And perhaps could make billions of dollars off their AI platform. And you need a huge number of these chips to make a chat AI, with some analysts saying this could be a $5 billion opportunity minimum. NVIDIA is the way to play it. I once named my late dog NVIDIA. Let me put it this way. Anybody can claim the AI mantle, but other than NVIDIA, Microsoft, and maybe Google, I'm skeptical of everyone else. Still, what matters here is that you understand the difference between hype and hope versus cold, hard reality. I like the industrials like DuPont or Liddy because they're all about reality. I'm skeptical of stocks that rally because they're firing people or cutting expenses. That's not what I'm looking for. Sure, there have been one rare case, Meta Platforms, the old Facebook, where they announced huge cost cuts. Then the stock gave you a phenomenal run because they delivered a magnificent quarter. But that's because Meta is now behaving more like the old line industrials. You know, Meta came down enough to become a value stock. It was like at 14 times earnings. And now that Instagram's reignited and Reels might be profitable soon, it's become a nice growth story. Plus, Mark Zuckerberg announced a massive buyback. If any other tech company wants to give you a $40 billion buyback, I might give you a seal of approval, too. Bottom line, in this environment, I just want you to have a real earnings cushion with real buybacks, real dividends. Ideally both. And I can't feel comfortable recommending anything without them. You can't cut your way to better sales, for heaven's sake, even if you try. How about Kevin in Pennsylvania? Kevin!
Hey, Jim, go Eagles.
Go Birds!
Hey, of these two stocks I'm going to mention to you, which one is the better buy right now, Datadog or T-Mobile?
Well, let's see. T-Mobile, Moffett-Nathanson says is slowing down. Datadog had a bunch of downgrades last week. But T-Mobile makes a lot of money, and Datadog doesn't make money. T-Mobile! Okay, let's go to Alan in New Jersey. Alan!
Hey, Mr. Cramer. I'm in America here.
What's going on, my friend?
Hey, I had to ask you about transportation on, planes, boats, trains, anything that goes. And I had a question for you. What is your take on Alpha Lima? That's American Airlines. What do you think it might do? I'll tell you
Well,
what.
I like AA. I like AA. I had a nice flight the other day on it, as a matter of fact. It's good. I like it. I like Delta, too. I think that group is hot. People are going, the people are traveling like darn fool heads off their regular, going on planes and I like the airlines because there's just no end to travel. I listened to Hertz call today. That's what they told me. How about Karen in Florida? Karen!
Jim, hey, I'm in Jacksonville, and I want to tell you before I ask my question, I thought you did great at Miami University. I watched that show. That was good.
Well, I'm going to tell you something. My wife passed Jacksonville about 25 minutes ago. She's on her way to Florida, and you know what? We can't wait to go back to the U. What a school. What's happening?
That's awesome. Okay, my question, I'm wondering how you feel about this. I'm wondering how you feel about United Health Group, UNH.
UNH, look, it's out of favor right now. It had a great quarter. I like Humana more. It goes down every day, but they all can't go up at once. But I know that Humana and UNH both had good quarters, and that's what matters to me because I'm playing a long game, not the short game. All right, in this environment, I just want you to have a real earnings cushion with real buybacks or real dividends, ideally both. And I can't feel comfortable recommending anything without them unless the multiple is so low on earnings. Oh, man, money tonight. Despite reporting a mixed quarter, Lindy's stock jumped higher. So what had Wall Street interested in this big industrial that I went through in about 10 seconds in the first block? That's okay. That's what I do. I'm discussing with the CEO. Then it was a tale of two video game makers, Activision Blizzard versus Take-Two. I'm running through reports from the two companies revealing the player that I think is headed in the right direction. And then Chipotle. How about this one? The reported earnings after the bell. Everyone hates it. I don't know. I kind of like it. Let's see what they dished out. Talk to the CEO. I think you should stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.